Hi, everyone. Just wanted to start off by thanking the She Loves Tech team for putting together this wonderful conference and for having us here today. My name is Dawn, and I'm very excited to be moderating this awesome panel on picking winners in early stage investing. I'm a lawyer with McDermott, and Emery, and I'm currently leading the firm's venture capital practice in Singapore. It is an honor to be moderating this amazing panel today and sharing the stage with Pinn Lawjindakul, partner of Lightspeed Ventures. Virginia Tan, I'm sure all of you are already very familiar with her. She's the co-founder of She Loves Tech and the founder of Teja Ventures. And last but not least, Geetali Kumar, East and Southeast Asia lead for venture capital and disruptive technology investments for the IFC. So we hope to have some real conversations today and leverage the experience that is on this stage. As you can see, these ladies here are not only experts at early stage investing, they have also put their money where their mouth is, but they are also moms and moms to be, so congratulations. Before we start, I'm going to pass over the mic to them, give them a minute or so to introduce themselves briefly and to tell you where they're from.
Good morning, everyone. My name is Pinn, and I'm partner at Lightspeed Ventures. We are a global multi-stage investment firm, which just means we do both, early and late-stage investing. We've been in Southeast Asia for about 3 years now. Mostly, I spend my time investing in consumer and fintech companies, across Southeast Asia. So a little bit more me.
Virginia?
Hi, I think all of you guys would know me by now. I'm the co-founder of She Loves Tech, and actually She Loves Tech and the entrepreneurs from She Loves Tech is actually what inspired me to become a venture capitalist, because there were a lot of startups in the early days of She Loves Tech, and they came to us. We would refer them to other VCs, and they would often come back and say, hey, put in a bit, support us. And I started off as an angel investor. I really wanted to support some of these startups. And then after a while, I realized I was never going to have enough money to fund all of them. And I said, okay, you know what? We need to build an institutional thesis. We need to build an institutional business case for this. And Teja Ventures was born. Our first fund, which we started in 2018, was focused on the female economy. And our second fund, which I launched earlier this year, as said on the previous panel, really is focusing on the future of consumption. We believe in investing with a gender lens, but I think I said this at INSEAD yesterday. I've always believed the gender lens actually was a commercial opportunity. And then very soon I realized I was the sole person who thought that way. And everybody had just put women and gender into a social bucket. And I was not okay with that. I built Teja because I believe women are a commercial opportunity and the biggest arbitrage opportunity of our generation. So I thank She Loves Tech actually for taking me down that journey. And I'm still really learning a lot.
Thank you, Virginia. That's great. Geetali, on to you.
Hi, everyone. Nice to meet you. So I'm Geetali. I'm based here in Singapore. I work with the IFC, which, as you might know, is part of the larger World Bank Group. Within the IFC, we have a focus team that focuses on investing in venture capital and disruptive technology investments. So our focus is investing both directly in innovative tech companies which are at a growth stage, but also selectively investing in VC fund managers globally. Our portfolio, we've got about 50, I would say, investments globally in tech companies and 50 fund managers in the VC space. I think, gender lens investing and inclusion-based investing is a key part of what the IFC and the World Bank does and stands for. We've come up with statistics or done research to say that in emerging markets, less than, I would say, 10 or 15% of corporates are represented by women, but actually the ones that outperform are the ones where you do have more gender diverse and in general more diverse teams at the board as well as corporate level. So looking forward to this conversation. Thanks, Sharon, for having me, and look forward to this panel.
Thanks for the introduction, everyone. As you can see, we have a very experienced panel here today. So we'll start off with the questions. In this market, there's a whole lot of geopolitical uncertainty. Interest rates are rising. As we all know, the recession is looming. And a lot of investors are being a lot more cautious with deploying capital. There's a huge talent of talented entrepreneurs and founders here today with great ideas, and I've spoken to a lot of them over the last couple of days. They're so excited about their business. The million or maybe billion-dollar question, how do you pick winners in early stage investing? So some people view early stage investing as an art, some view it more as a science. I would love to have your views on this. How do you pick winners in early stage investing? Pinn, do you want to start off?
Yeah. Maybe first as context, specific to early stage investing. At least at Lightspeed, we have a view that we take, a 10, 15-year view to investing in early stage companies. So macro, short-term macro environments such as interest rates and, geopolitical tensions don't really play into our decision making as much. So, that's all to say that we are almost business as usual. I would comment though that in an environment like this, I know there are a bunch of founders here in the room, but from a data perspective, from a pipeline perspective, I think there are a lot of aspiring founders that are actually a bit more uncertain, right? In this environment, this is the first time Southeast Asia has ever experienced, almost what it feels like a mini .com bubble, right? You see, we've never seen Google, Facebook, Stripes of the world announcing retrenchment. I think people of our generation are actually, I speak to founders or aspiring founders, they're like, actually, let me just stick around to my well-paying job for a while and see what's happening. So that's data, right? So that's the second point. Right. So with that as a context, I want to go back to what do we actually really look for in founders? I think a few things. One, we can talk a little bit more later, but kind of just diversity of the team and in their thinking mostly, right? And I don't particularly invest within a gender lens, but I think we can cover that later. We look for leaders with ambition, with a lot of energy and clarity in what problem he's trying to solve and why that's a big problem, and some sense of his solution. It doesn't have to be well thought out, but I think some thoughtfulness in why his approach is going to be quite different. I think that's just the core of what we look for in teams. In an environment like this, we always expect unit economics to be a conversation to have, right? And it doesn't have to be like, well, how are you going to make money tomorrow? But let's assume you can't raise the 20 million, 30 million, $50 million checks. What are you going to do with your business? How does that pan out? So I think these are kind of conversations that come to the forefront just because of the macro conditions, but it's not a kind of a deal breaker for us at this moment, given our focus ultimately is in the team and the problem they're trying to solve.
I think in addition to everything that's been said, at the early stage, there's not much track record, right, of these companies. There's not much, history. So I think one of the key things we look for, at least in founders, is do they have a growth mindset? Do they have the ability to take feedback? And can they actually navigate when things get hard, right? And I think that's very obvious and evident in this environment today, where things were very different last year, and the environment is very different this year, and have founders been able to adapt or reiterate their business models to even survive, right, in this market. So I think the folks that we've seen who've actually been able to successfully do that is really the people who've had that ability to change their mindset fast, take advantage of the situation fast, and sort of execute faster. So I think that's one of the key things that we look out for in founders' soft skills when we try to evaluate them. So yeah, it's a bit more of a, as you said, art than a science. There's a lot of feel that you have to generate about the founder before you invest. So we do spend enough time with these founders to see that and then sort of invest.
I want to address, both questions. I'll start with the macroeconomic sort of context, right? I like what Pinn said that, when you take a long-term view, because venture capital is actually quite a long game, 8 to 10 years at least, right? You're looking at it as in terms of exit horizon, and not really taking that into account, the short term. The first thing I wanted to say is that a lot of great unicorn companies actually came out of times of recession. and they came out of times of great uncertainty. And I think one of the things that we believe at Teja is that you must believe, regardless of the economic climate, that innovation really is a growth driver. But I think the key for a lot of VCs at this point in time, and we are becoming a little bit more cautious and slowing down deployment, is actually, are you still really investing for value? Because a rising tide, basically lifts all boats. But a sinking tide means that only the real winner is survival of the fittest. What we've noticed actually, when I looked at previous recessions, is that the companies at the top of the market will still raise. The market leaders will still raise. In fact, it's what we call, flight to quality, right? So that's the first piece. In terms of looking at winners, we spent a lot of time this year actually at Teja really refining our investment methodology. Obviously, nothing will replace the founder at early stage. You're betting in people and talent at the end of the day, and you're not betting on one person, which is what we're learning. You're betting usually on a founder and a team and that ability to build the team. The second piece that we look at is actually really categories, because obviously our second fund is focused on future of consumption. And I think the question we're asking ourselves, right, is that you can bet a great person, but if you are picking the wrong market or you're picking the wrong category, and categories have a lot to do with time as well, then even if you pick the best person, that category may not survive, right? And what is that? Is there a real addressable market size? Is that a real market which is saturated or disrupted? And then the third piece is that if you get the first two right, what are really the ingredients which allow you to create, or to bet on the market leader? Because in a market, for example, I think US and China are quite interesting actually when I look at it. China, you can have top two players. US, you usually have top player, right? And Southeast Asia is smaller than both of these. So really, you want to be betting on the winner. So these are some of the factors that we really looked into. And this year, we've actually gone back to basics, super doubling down on things like founders, red flags, and really focusing the team on market sizing.
So you mentioned something about red flags. When interviewing founders, what are the red flags that you look out for? Is there anything in particular you can share with the founders in this room? What should they not do during an interview or a pitch?
It's not an interview, right? I mean, we're VCs, right? We're not supposed to. I would never bet on a founder where I knew more than the founder, right? That you have to have respect for entrepreneurs and that they'll definitely know the business and the vertical more than you. And if they don't, then perhaps you shouldn't really be investing. We had a very interesting discussion internally recently. Is it a founder red flag or is it just a diamond in the rough? So basically, if a founder doesn't have something, for example, you have a great product technology founder, really good at building product, really good at building team, but actually really sucky at raising capital. So is that a red flag? Or is that just what we call a diamond in the rough, which needs time and coaching and support? So those are some things we're grappling with. I think a red flag, I would agree with Geetali actually, is a founder who is not self-aware, not coachable, doesn't want to take feedback, basically doesn't want to change, especially when the environment is changing. I think that is a big red flag. I think a founder who doesn't care about governance at all, right? Doesn't bother with board meetings, doesn't bother taking advice even when times are bad. I think that's a real red flag. And I think the third red flag, and that depends fund to fund, is it's really a cultural fit. Different funds like different types of founders. And if there's a founder which is just maybe a good founder but just not a fit, for example, a founder who's hyper local and you're an international fund, they just may not be a fit. So these are some of our red flags. Yeah.
I'll keep mine really short and sweet. I think red flags for me, founders who show up and say this is like a mega TAM. There is no competition. And when we discuss about comparables in other parts of the world, nothing. Like we're the first. We're very innovative. I think these are just signs of ambition without thoughtfulness, right? So and then the other one, which obviously is important to us, is also integrity issues. We do a lot of background check on these people, and the moment there was, then we generally it's a better not to have in our portfolio than have it. Yeah, but yeah, I think the first are the ultimate ones. Like guys, the TAM is always not that large. There's always competition, and yeah, you're really not the only one who has thought about it, probably. Yeah.
So know your competition. Geetali, is there anything you want to add?
I think they covered it well, but I think, I think governance and integrity is a key part. We spend a lot of time reference checking founders and spending time with them before we invest, because we take a long-term view to investing. We're with these guys for at least 5 to 7 years, right? And I think integrity plays a key role. I would say, what else? Somebody who's not trashing other people in the market or talking badly about their competitors and peers. We've seen that also happening, and I think I think it goes down to maturity of the founder, and if the person can create a solution or a product or a service which is he's proud of, and not just bashing other people about it. So.
I want to just add something real quick. The opposite of red flags are what are the things which make founders winners, right? And we came down to 3, and we're still debating internally if they have 2 out of 3, that's okay. What if they have 1 out of 3, right? We're trying to think about it more in a more disciplined way. So the 3 things we felt make founders stand out. One is obviously having deep product technology, sort of, what I call a product technology founder, someone who thinks, is a builder, really. And can do that better than the rest. The second one we have is actually what we call someone really good at capital, right? They can just raise more money, they can sell more, etc. And then the third one is actually someone who can really build an amazing team, right? And that will take you beyond 0 to 1, 1 to 10, 1 to 100. And so what we've been asking ourselves is, out of the 3, what's actually the most important? And I actually love to hear what Geetali and Pinn think about that. Is that like all 3 must all 3 be present for you guys, or is it like you would invest on one alone? Because I started to realize actually one of the things I realized, and it's one of my learnings actually as a young venture capitalist, is you can be really good at product and have a superior technology. You can have a good team, good at people, but if you're not able to raise capital sometimes and you're not revenue positive, right? That can still kill your company. So that's an internal debate for us, actually. Yeah, I'd love to hear what other people think.
I think that at the end of the day, it all boils down to ability to, I guess, articulate and be very clear about the vision that they have, right? So that's number one. And it doesn't have to be in English, right? It can be in any language, because I think that will help to attract talent, that will help to guide product vision, and that hopefully also brings in capital. So, and it's a tough one for us because then it is a nature or nurture issue, right? So at least in our firm, we tend to unfortunately think that it's a little bit more nature. Yeah, so we might, not get there because of founder's inability to articulate his vision and ambition, even if we know intrinsically he has them.
I think you put it well, Virginia, because we've done some analysis on our portfolio, and we've actually done some analysis on the CXO teams, on the founding teams, and we've seen that multi-founder teams are better than single-founder teams, and I think the key reason for that is because multi-founder teams bring a sort of complementary skill set, which can focus on different aspects of the business, and then that can essentially help you grow faster, right, in a way. So I think in early stage companies, what we see is, sometimes we have 2 founder teams or 3 founder teams who bring these complementary skill sets, and then with our funding, usually you can still continue to build that strength at the senior level and sort of go deeper. So if they lack, let's say, fundraising skills, we help them sort of try to hire people who might be able to support that function, and I think that's key. So I think you're right, we think about those 3 aspects when we do go into founding teams.
So I think one of the things that you touched on previously, Virginia and Geetali, was this idea of growth, and the founder needs to be receptive to growing, to new ideas. You also touched on, fundraising, raising more capital. There's raising capital from, there's money, and then there's smart money, right? And depending who you raise from, that can change your company, that can give you opportunities that the founder themselves might not be open to. Can you share some examples about maybe how you have worked on with a company before that you invested in who was maybe not quite a winner at that point? How did you help them turn the company around to become a winner?
I like that question. It's in Teja methodology speak, we call it the diamond in the rough. And one of my partners now, David, who's based in Indonesia, is actually, he loves creating checklists. So he's actually creating a checklist of what makes a diamond in the rough versus just a red flag. I think the beauty about building your own venture capital fund is that you, on some levels, right? I mean, you have to play by the rules of the game, but you get to create a few rules of your own. Teja really likes to look at diamonds in the rough. So going in early, being that first check, where we're seed or pre-seed fund, and looking at something which isn't a winner yet, right? But we think actually we've identified what we call the VC value driver. It's something actually in our investment process. If we can identify what we think the VC value driver is, and some companies there just isn't, right? It just isn't that kind of business, and we think that the founder actually has that growth potential, then we would make that early bet, and really guide that founder towards that. So a good example of this is a company called Green Rebel, based out of Indonesia. They're now the market leader for alternative meats, actually in Indonesia, and they're actually growing across the region this year faster than I expected. When we first met the founder, her name is Helga. She spoke last year at our conference. She was running Burgerines, which is a chain of 10 restaurants, right? And she came to me for funding. I'm an absolute foodie and I love her food, but I was like, we're VCs, we don't invest in restaurants. This is a PE play. You should get impact investment money or PE money, whatever. And then she came to me the second time and I said no again. But after spending time with her and her co-founder, Max, who's actually her husband, who is actually on the product side, what we realized is that these founders actually, their strength wasn't F&B. Their strength actually was food science and product development. And they were pioneers in the market. They knew exactly how to create these products. And so I said, okay. And then we thought, what is the VC value driver of this? And I said, the VC value driver of this is actually consumer packaged goods. Are you willing to build a consumer packaged goods company? Are you willing to build a food lab? If you are, I will give you that first 250K. It turns out that the founders were thinking this the whole time. And I know because every single VC rejected them or gave them like ridiculous terms like 3x liquidation preference. And anyway, so what they did, we put that check in. They went to market in 4 months, product, everything, and they started selling on Tokopedia, they started selling to Starbucks. And then right after us, Beyond Meat's first investor came in, a very large, very famous food tech fund called Unovis. It's their only Southeast Asian investor. And then after that, the VC money started to pour in and so on and so forth. So that's an example of taking a chance on a founder because you realize actually their business model is not necessarily aligned to their real strength. But in this case, there was real alignment. I have a lot of other examples, but I actually find why VC, I mean, as a VC, your job is actually to find the opportunities which are scalable or scalable in the VC sense. And not all companies are like that. And then the question is for the ones who are not yet there, can you actually bring them on that path so that they'll be able to absorb capital on a greater scale? And with Green Rebel, we've done that. We've done that with a couple other companies as well. Not every company is like that or should be like that. But I actually think that a lot of times founders don't get funding because they're not exactly the type of founder that we expect in a VC context. And and this leads to the wider inclusion context. But maybe I'll let Geetali and Pinn.
Yeah, I'll just address the question more directly. At Lightspeed, we have a talent support team, marketing support team, and that's, kind of an ongoing engagement that we provide, or I would say in support or services that we provide to all portfolio company. But more importantly, we have a very concentrated portfolio approach with a team of pretty senior investments folks. So, and we place a lot of the portfolio management or the support role on to the investment professionals themselves. So each of us, maybe at every point in time has 8 active board membership, and we do 2 to 3 investments in a year, and so that we can free up time and our own resources to be real thought partners to the founders. I don't think we claim to save everybody. I do think that it's a different model from more traditional and early stage investing where you just have each partner do 10 deals a year, and you only work with the winners in the portfolio. We take in the more US frameworks a benchmark capital model approach, right, where we believe that we might not know how to save or work with every company, but hopefully the role of a real thought partner board member is one that complements whatever the founding team needs. Yeah, so it's how we serve our founders.
I mean, yeah, just to add that for us, when we invest, we try to bring the entire organization right when we invest. So not just the IFC, but the World Bank Group, and try to support founders in, opening new markets, or it could be like regulatory hassles, or even as been said, hiring senior leadership for them. I think the advantage that we have is because we are a global investor. We do see models in different markets. So, something that's happened in, let's say, in China 7 years ago, or, in India 4 years ago, we kind of see similar trends in Indonesia today, like, for example, right? So we are able to also share these kind of global learnings with our founders and sort of tell them about the challenges and, other things that we faced in these other markets, and that they could already be aware of some of these things when we go into investments. And we are able to have a very concrete discussion with them about how they're going to, overcome these or think about these. And I think that sort of brainstorming and thinking is also something that we try to do to see, the strength of these founders.
Well, thanks for sharing your experience. We have less than 4 minutes left, so just a last question to wrap up this session. We talked about how, for venture capital, it's a long-term play. It's not so dependent on the current economic situation. But I'd like to find out, what is your outlook on the next, say, 2 years? Do you think the valuations are going to be going up or down? Is it doom or gloom? Or are there more opportunities for, say, startups and founders who are looking to raise in the next 12, 24 months?
Okay, maybe I'll go next first. I mean, I think I'm a big believer in the region, first of all. So I think Southeast Asia is a great place to invest. So if there are investors in the room, please stay optimistic. While everyone talks about a long winter and long sort of funding compression, I think the founders who are solid and who are fundamentally strong will continue to grow. And I think investors will continue to invest in them. So there's definitely going to be a flight to quality, as you said, Virginia. So I think that's going to be very healthy for the environment, because I think the unhealthy competition which was happening last year, throwing marketing dollars and all that is going to reduce. So you'll definitely see the winners emerge. And to your point on valuations, I think valuations are already becoming more rational and fair, and which will be great for investors like us, because we can now invest in companies at fair prices and, show that in the next 5 to 10 years, we as investors can make returns, right? And that's just great for the ecosystem, because that just creates more interest from global investors and others. So yeah, that's what I would say.
I don't have
Pinn?
anything that new to share. I share the exact same views. I think it's a great time to build. I think there are a lot of capital sitting on the sideline that are interested in Southeast Asia. I mean, we can say what we want about how Grab, Gojek, or Sea is doing in the public market, but it is still, kind of a big milestone for the region to even have anyone up there in the Nasdaq. So I think most of the capital remain quite optimistic about this region, and yeah, I think it's a very good time to build and be thoughtful about building good businesses.
Virginia, final words?
Just thoughts on a micro and a macro level. On a micro level, we are encouraging all of our portfolio companies, to have 2 to 3 years runway, right? And to really take the next 2 to 3 years to whatever capital you can raise or you have raised, to use that to become the market leader. Because take advantage of the time when others may struggle. So that's the first thing on a micro level. On a macro level, yes, like Pinn and Geetali, I am a bull on Southeast Asia. I believe investment is always about timing. And there, I do think, recession or not, there's quite a unique demographic opportunity set in Southeast Asia between 2019 to 2030. I lived in China for 10 years before coming back to Singapore in 2020. And what I saw are the convergence of 2 factors there, which I now see being repeated here. The 2 factors are this. On the one side, you have the rise of the middle class. And on the other side, you have the explosion of the digital economy. In China, the rise of the middle class is from the 2000 onwards, but the explosion of the digital economy really came in 2012, when you have things like WeChat and the second big wave of Chinese tech companies. In Southeast Asia, because of the pandemic, we have the next 10 years, 2020 to 2030, to see an estimated 60 to 70% people move into the emerging middle class. And on the same time, the acceleration of the digital economy post-pandemic. The convergence of these two factors is what I call, we call this middle class consumption upgrade. And I think that there will be opportunities here, especially in the internet economy, that we won't see again, regardless of recession. And it's what I saw in that 10 years in China. And so I think, I think we should leverage that time, because whether we like it or not, consumer spending will still double within this time because of that emerging middle class. And that's never happened before.
Well, I think that's come to the end of our discussion. So thank you again. Give a round of applause to Geetali, Virginia, and Pinn.